Thank you. Too late now. We'll have to, I'll staple it when I get in. Yeah.
We're supposed to assume a growth rate for the last one.
You don't need one. Why would you need a growth rate? This one, the growth rate is given.
Number 3? Oh, I didn't have that version.
But they both give you a growth rate. Both versions have a growth rate.
I'm meaning on the second one.
You don't need one for the. Okay, folks, get settled in. Thank you. Okay. The usual rules apply, so when the quizzes are ready, I will let you know. You can come pick them up. So how many unknowns can you have in one equation? Just humor me. If you have one equation, how many unknowns can you have? One unknown, right? Nobody's ever figured out a way to solve two unknowns with one equation. Problem 1. You have to get a price to book ratio. What seemed to be missing in the problem? ROE and cost of equity. You're saying how the... But that was a little... That was not true, right? I did not give you an ROE directly, but what did I give you instead? I gave you the payout ratio and the growth rate, right? You're saying that's tricky? Then it's not tricky. The facts are there. You could back out the return equity from those two numbers. Without that, you're going to have two unknowns, and there's no way you're going to be able to solve for the price to book ratio of the subsidiary. Okay? On problem 2, there was one line item there that really made the problem go from being a slam dunk easy problem to a problem where you had to think. What was the line item? Investments in other companies, right? What is that? Why does that matter? When you compute return on invested capital, what have we usually done? Debt plus equity minus cash, debt plus equity minus cash. Except in this case, you have investments in other companies. Does it affect your return on invested capital? Why? Why does it affect your return on invested capital? Because it inflates your book value, right? Because you have it. But because you don't make, remember it's a minority holding, so the operating income from those holdings are not part of your operating income. So if I take the operating income and divide by book value of equity plus debt minus cash, I'm actually understating your true return on capital. It's not, it's a fairness issue. You take it out for the same reason you take cash out. The income from cash is not part of your operating income. Therefore, the income from your holdings is not part of your invested capital. That's really, in fact, as I wrote the quiz, that was the one thing I knew people would be tripping up on, because I've seen this happen with minority. Remember what I told you about cross holdings? It takes like 100 years of practice before you get them nailed down, because you got the minority interest, you got the minority holding, you subtract one out, you add one out. That was really the only, if you can call it, tricky part of the second problem. The third problem was just 3 slices, right? You just had to make sure you valued those corporate G&A as a value, subtracted it out, and compared it. The one other thing about part 2 that you might find yourself disappointed about if you didn't do it right was, what did the problem ask you to do? How under or overvalued the equity in the company was, right? You're saying, what's the significance of the equity? Because you can do things on an enterprise value basis and compute a percentage difference, but that percentage difference will not be the same difference as percentage in equity value, because equity, so it's really, I mean, you have to get from enterprise value to equity value, and there again, guess what's going to rear its ugly head? Investments in other holdings, right? So it's going to get you going, and it's going to get you coming back. But there's really nothing you can do about it, because it does affect your return on invested capital, and it does affect your equity value. So enough about the quiz. We'll, as I said, I'll get the quizzes back to you. On the final exam, has anybody looked at I haven't looked at the sign-up sheet today. How many people are signed up for the early exam? Does anybody know who checked today? I just want to find out if the room is big enough, because if it isn't, then I have to do some juggling. So the final exam, for those of you who have no idea what I'm talking about, there's a regular final exam on May 15th, which is the Monday. It's 1 week after the last class. And there's an earlier version of the final exam on May 11th. So if you want to take the early version, I said go sign up on that Google shared, the Google Science spreadsheet. So if you haven't signed up, please do, because I need to know how many people are taking the early final, so I have a room big enough to accommodate you. Okay, so let's pick up where we left off when we were talking about options. Last Wednesday, we were talking about the patent that a company owns as an option. So we said you can have a non-viable patent, a technology that's not viable today, but it can have value because at some point in time in the future, it can have value. What I'm going to talk about next is going to resemble the option very closely, except it's a different set of a different language. Does anybody know what oil prices are right now? About 52, I think, 53. It's down. You know that in the US there was this explosion of shale oil production starting about 10 years ago, as oil prices climbed to 80, 90, 100, $120 a barrel. So across the world, companies went out and explored and found oil that looked viable at a $100 oil price. So let's say you're one of those oil companies. You're Petrobras. You found all these great reserves. The only problem is these reserves are viable at 120 or 130, maybe $90 oil price. But let's say the cost of developing this oil is $75 a barrel. So I'm going to separate the next two questions so we can kind of deal with them separately. Oil price right now is 52. It will cost you $75 a barrel to get oil out of the ground. Would you develop that reserve today? No, it doesn't make sense, right? The cost is great. Let me ask you a second question. Would you be willing to sell me that reserve for nothing? Why not? It's a useless reserve to you. The cost is greater than why would you hold back on selling it to me? Why is it not worthless to you? Because oil prices could change. Do you see how the rationale is very similar to what we use for patents? Just because a reserve is not viable today doesn't mean you will give it away because there's some optionality. So let me set up what the option is going to look like. The cost of developing the reserve becomes equivalent of the strike price. If the value of the oil under the ground exceeds that cost, you will develop the reserve and make the difference. If the value of the reserve stays below the cost of developing it, you'll sit on the reserve for as long as you have the rights, and at the end you'll hand it back and say thank you, but no thank you. An undeveloped natural resource reserve looks a lot like an option. So let's set up how we try to value the option. So let's go input by input, and again what we're trying to do is get those 6 inputs to the option pricing model. So you are an oil company, you have undeveloped reserves, you ask me to value those reserves. The first number I'm going to ask you is tell me what you would make if you develop these reserves today. You might say, I don't plan to, but it doesn't matter. Just give me what you would get if you develop today. So you're going to come up with the oil you're going to produce every year for the next 20 years, get the expected cash flows, discount them back. What you get as a present value is going to be the value of the oil under the ground if you develop today. So that's going to become the S in your model, the equivalent of the stock price. The second question I'm going to ask you is how much will it cost you to develop this reserve? Do oil companies have a pretty good sense of what it will cost to develop a reserve? North Sea, Gulf of Mexico, Alaska. You've done this before. It's not like you're going into it's not a blank slate. You can, so you tell me this, it's going to cost me $1 billion, $500 million. That becomes the strike price. You know how long you have the rights to do this? As long as you've been granted the rights. There are two ways you can get rights to reserves. One is you can go to an auction and bid, and you get the rights for the next 15, next 20 years. The second is, like Aramco, you get endowed the rights by the government, and the life of the option will then be either the period before which you've got to turn back the reserve to the government, or however long it will take you to exhaust the oil under the ground. So that becomes the life of the option. For the variance in the value of the underlying asset, what's the number I'm most uncertain about in the future? I know how much reserves there are under the ground. I know what it will cost me. I don't know what the oil price will be, right? This is actually one of the easier real options to value, because can I get a variance for oil prices? Unlike a patent or a project where I have to do simulations, this is a traded asset. I can go look it up on Bloomberg. That variance in the price of the resource becomes the variance I use in the option. Now comes the tipping point, right? Because if I don't force you to develop the reserve, you'll just sit on the reserve and hope that good things happen. So let's say your reserve becomes viable. Oil prices go to $85 a barrel. You could produce the oil now. Part of you says, let's wait a little longer. Maybe oil prices will go to $120 a barrel. But if you do that, if you decide to wait, here's what you will give up. If you develop those reserves, you'd have got cash flows from the reserves, right? And by not developing the reserves, you're turning those cash flows away. That becomes the equivalent of a dividend yield or a cost of delay. I'm putting it in there to trigger early exercise. And finally, and here's one of the features of natural resource reserves that you got to build in. Let's say oil prices go to $120 a barrel tomorrow. Don't ask me, Middle East crisis. That's one almost always around the corner. ExxonMobil CEO picks up the phone and says, develop all our undeveloped reserves right away. The phone call goes out. Will there be oil coming out of the ground tomorrow? See the question I'm asking? If you decide to develop reserves, you're not going to get the oil out right away, because you've got to get the rigs on the ground, you've got to get the engineers there. It might take you a year and a half, 2 years. That's called a development lag. You're saying, so what? Does having a lag reduce the value of your option or increase the value of your option? It's going to reduce it. Why? What are you worried about will happen in the 2 years? Why did you pick up the phone? Because oil prices went to 120, right? By the time the oil comes out of the ground, oil prices can be down to 60. You can try to lock in some of these prices with futures or options. So the first thing you worry about is, hey, what if oil prices go back down? The second thing you worry about is there's a present value effect, right? You've got to wait 2 years for your cash flows to kick in, and that's also going to lower your value for the option. So here's what I'm going to try. I'm going to take a real oil company, and this is way back in time, and I'll explain why I had to go back this far in time to try this out. It's a company called Gulf Oil. It was targeted in a hostile acquisition in the early 1980s. And one of the reasons it got targeted is huge undeveloped reserves, 3.038 billion barrels of oil, and the average cost of developing these reserves was about $10 a barrel. So 10 times 3,038 is $30.38 billion. They're willing to spend that much, they can develop all these reserves. The average life of these reserves was about 12 years. Remember I said you go and bid in auctions, the average life of the reserves was 12. The price of oil per barrel was $22.38. So you can see how far back in time this was. So if you develop the reserves right now, you get $22.38. The variable cost is about 7, so on a per barrel basis, you make about $15.38 a barrel. The T-bond rate at the time of the analysis was 9%. That's a risk-free rate. And the Gulf was if it produces the oil, develops the reserve, is expected to have cash flows which are about 5% of the value. By not developing the reserves, that's what it's leaving on the ground. So here are the inputs I'm going to use for my option pricing model. Okay. First, I took all of the reserves they have, 3,038 million barrels, assumed that they would develop the reserves right now, and on a present value basis make $15.38 a barrel. So 3,038 times $15.38. I forgot to mention it takes a 2-year lag between when you decide to develop and when oil comes out. So I'm going to take out the cash flows for the first 2 years. It looks like I'm discounting, but I'm actually taking out the 5% cash flows for the first 2 years. What I get as my value is $42.38 billion. File that away. That's my discounted cash flow value of developing my reserves instantaneously. The cost of developing these reserves is $30.38 billion. Let me pause right there. You're going to make $42.38 from developing the reserves. You have $30.38 as your cost. If I ask you to do the net present value of these undeveloped reserves, you're just going to take that difference, right? Which would be about $12 billion. So farther away, that's your DCF value for these undeveloped reserves. Now let's bring the optionality in. There's 12 years that you get to play. The variance in oil prices was 0.03, so that's what you're calling on. The riskless interest rate was 9%, and if you decide not to develop the reserves, you leave those cash flows in the ground, so that becomes the cost of delay of the dividend yield. I plugged it into the dividend yield adjusted Black-Scholes, and I got D1, D2, N of D1, N of D2. Let me pause right there. Do you remember what I said N of D2 measures? I said it's roughly speaking a probability that the option will be in the money. That's what an N of D2 is. In this context, what am I saying? There's an 85.4% chance that what will happen? That Gulf Oil will actually develop its 3,000, which is no surprise. They're in the money reserve, so it doesn't surprise me the probability is so high. But if I plug those numbers in, the value that I get for the call option is $13.3 billion. What was the net present value, the traditional net present value? $12 billion. Viewed as an option, I'm giving them an extra $1.3 billion. Remember I said the excitement of options, you add a premium to DCF value? Where is that extra $1.3 billion in value coming from? I want an intuitive explanation. Magically, I've taken a $12 billion DCF, made into a $13.3 billion value. Fernando. In other words, that's the optionality. If oil prices go up, by waiting I can get even more value. That's what the extra $1.3 billion captures. Which means if you're an oil company with a lot of undeveloped reserves, your value rests both on the price of oil and the variance in that price, because the higher the variance in the price of oil, the more the value of these undeveloped reserves. So these undeveloped reserves viewed as options are worth $13.3 billion, more than a traditional DCF valuation. So I'm ready to complete my Gulf Oil valuation. Gulf Oil had about $915 million in cash flows coming from developed reserves already. So these are not options, they're already developed. And there were about 10 years left of oil in the ground. And at a 12.5% cost of capital, the present value of the reserves, the developed reserves that Gulf Oil has is $5.065 billion. You add the value of the undeveloped reserves, you get a value for the firm. So this is like an enterprise value from a DCF. You subtract out debt, and you get a value for equity of $8.47 billion. If you wanted to, you could value a natural resource company as a sum of two numbers. The value of developed reserves, valued as a DCF, and the value of the undeveloped reserves, valued as options. So with natural resource companies, check for those reserves, because those reserves can have value. Now, have any of you seen, are any of you valuing oil companies or natural resource companies? Nobody? Okay. Do oil companies report on their undeveloped reserves, so we could do this with the undeveloped reserves? Because if they did, why am I going back to 1984? Right? Here's what oil companies are required to report based on current accounting standards. They're required to report, of course, their developed reserves, and they're required to report what are called viable undeveloped reserves. What does that mean, viable undeveloped reserves? In option language, what kinds of options are they being required to report on? Reserves that you could actually convert today and make money, so in the money options. They don't have to report reserves that are not viable as part of their 10K. I wish they did, because I think we need to know it. I'd like to know what ExxonMobil's undeveloped reserves are, not just the viable portion, but the non-viable as well, because I need that to use this approach to come up with the value of the entire company. Any questions on undeveloped reserves? Let's move on to the option to expand. The option to expand, as I said, is two projects. The first project is not an option. It's actually a bad project, but you're going to take it anyway. Why? Because that bad project can give you the rights to a much more lucrative project, a bigger market, a bigger product, a bigger service. So here's the way to think about it. Right? If you have the option to expand, you will sometimes take negative net present value investments, not because you're crazy, but because you think that negative net present value investment will give you options to do other things in the future. Again, let me try it with a payoff diagram. So you take an initial investment, it's a negative net present value investment. You're doing it in the hope that somewhere down the road you're going to get this option to expand. The cost of expanding becomes the strike price of this option. You will expand only if the present value of the cash flows from expanding exceed that cost. And if that never happens, what do you lose? What did I describe the first project as? A negative net present value project, right? So if you never get the option to expand, you've basically taken that negative net present value project. That becomes the cost of the option. That's your option to expand. It's an option that allows you to go to big markets knowing you're going to lose money on an initial investment, hoping that the option pays off. So I'll show you where this can be used. Let's assume I'm valuing a young company. It's, in this case, a small antivirus software company. Let's call it Secure Mail. Let's say you do a traditional DCF of the company, free cash flows firm, discounted the cost of capital, and the value that you get for the company is $115 million. So if this were a DCF valuation, we're done. But then I say, wait, there's one more thing I need to tell you about this company. As this company runs its business over the next 5 years, it's going to be collecting data on its customers. Because it's selling virus software, it's collecting data on from its customers, which it can use to develop a new database program. So it's collecting the data and it's going to... It'll cost it $500 million to develop that new database. So if it decides to go with this new database business, it'll cost $500 million to enter. And if it does enter that business, based on what they know today, which could change in the future, they think they can make about $40 million a year after taxes, free cash flows for the next 10 years. Do you need to do any net present value calculation? No, it's a bad project. What are you spending up front? $500 million. What are you going to make even without discounting? $40 million every year for the next 10 years. 40 times 10 is 400. And if you start discounting it, you know that it's going to only get worse. So this, I'm already telling you up front, is a bad project. But here's the saving grace. It's also a very risky project about which you know nothing. Let me repeat that again. I said the best thing about the project is it's a very risky project about which you know nothing. See why, again, options are one of the few places where ignorance becomes your ally. You say, look, I know nothing about this, therefore there's an optionality here. So that uncertainty I'm capturing with a standard deviation of 50%, which means the $40 million I have as cash flows could become $80 million next year or $5 million. That's the uncertainty. The 5-year risk-free rate is 3%. Let's try to value this database option by putting in the inputs. S is the value of entering the market today. $40 million a year, every year for 10 years at a 12% cost of capital, which reflects the risk of the business, is $226 million. So if I decide to develop this program today, it'll cost me, the value that I get is $226 million. The cost of doing it is $500 million. So if I computed the net present value of this project today, it's 226 minus 500, which is minus 274 million. Horrible project, right? But I have 5 years, standard deviation is 50%, riskless rate is 3%. Plug in D1, D2, N of D1, N of D2. The value that I get for the option, this is almost magical, is 56 million. I have a project that's deep, deep, deep out of the money, negative net present value, but because it's an uncertain business, the value of that option to expand is 56 million. What does that mean? If I'm investing in this company, Secure Mail, remember the DCF value is 115 million? On top of that, I get an extra 56 million, which gives me a total value for the company of 171 million. About a year and a half ago, now after I'd been I was a big skeptic on Twitter for a lot of their initial years. I said, they're overpriced. When they got to be about in the mid-20s, the stock price got to the mid-20s, I actually bought the stock. It hasn't worked out very well, but I'll give you my rationale for why I bought the stock in the mid-20s. I did a DCF value and it came up with roughly the same number as the price. 25 value, 25 price, right? Looked fairly valued. But I still bought it and I used an options argument for buying it. What's the optionality you get when you buy Twitter that you're not capturing in your cash flows? In fact, I would say this optionality is going to be available not just in Twitter, it's going to be available in LinkedIn, it's going to be available in Facebook, it's going to be available in, yeah. I don't even need them to be the next Facebook. All I need them to do is find something else to do with their 300 plus million users, right? You see what I'm talking about? That's your exclusivity, is you have access to the, because let's face it, it's very difficult to get a user base. So if you get a user, they're doing an awful job with that user base today. But if they could ever figure out a way to use that user base, that optionality, maybe they can sell you stuff, maybe there's retail business, maybe there's information they can get from you. That's what we're missing in a traditional DCF. That's one reason. If Facebook becomes fairly valued, I'll buy it even before it becomes cheap, because to me that optionality will tip the scales enough that it say, look, based on just the DCF, it looks okay. And if I put the optionality on top, that's actually going to make it a more valuable company, because there are other things they can do with their 1.7 billion users. So this is actually a very interesting option to bring in. And in fact, it's the option that many investors in young startups are implicitly using when they say, the DCF is not okay, but I'm going to invest in it anyway, just in case they figure out what to do with their app downloads or their users. So that's the option to expand. It's in a way of adding that extra value. Now, I'm also going to give you the tools, the questions you need to ask to be a skeptic, because as you can see, it's a very dangerous option. It's going to induce you to invest in companies with terrible numbers. So here are some of the questions you might want to think about whenever you see the option to expand. Remember, I'm connecting two projects here, a bad project with a good project, and I'm telling you, if you don't take the bad project, you can't get to the good project. The first question you need to ask is, why do you bundle the two? Why can't I get to the second investment without doing the first investment? I'll give you one example. Let's assume that you're Marriott, you're thinking about opening 10 hotels in China, and you work out the net present value. It's a big negative number. You decide to do it anyway because you say, look, if the hotels work out and they start getting a lot of customers, we plan to open 100 more hotels. So your argument is, I need to make the bad investment up front in order to be able to make the great investment later. You know what my pushback will be? Why don't you let Wyndham do it for you? Let them open the 10 hotels. Then watch them really carefully, because what you're trying to do is collect information about the market. You don't have to be the one going in there first. Let somebody else jump in, take the risk for you. So if you don't need to make the first investment, you don't have to bring it in as an option. Okay? So if you and the second question I'm going to ask is, assuming this works, tell me how you're going to keep the competition out. So if you actually use these 10 hotels to get information to decide to open 100, what are you going to do to keep the rest of the competition out? Maybe you have an exclusive license from the Chinese government. Then we can talk options, but opportunities are not options. And I told you last session, that's the title of the paper I wrote on this, is a lot of people think about big markets, there must be optionality there. Ask that question of, is there exclusivity? Because without it, the option value will start to dissipate. So let's put this, go ahead. Right.
Wasn't there the opportunity factor already built in that they could do something?
Yeah, we're building in the expected advertising revenue, but you know what we're missing? Why does it have to be just advertising? This is a question I ask about Facebook all the time. Valued as an online advertising company, Facebook has a value, you could argue it's really tough to get to the market value. But does it have to be just an advertising company? What if they figure out a way to deliver entertainment? You have 1.7 billion users, right? And they're on your ecosystem 1 hour every day. What if you can figure out how to deliver news to them? What if you can find a way to sell stuff to them, retail stuff to them? I haven't built it into my valuation because right now none of those things might be viable. But the fact that they have that user base means that it's possible. Remember when we told stories, we asked, is it possible, is it plausible, is it probable? And the possible, we said we can't build into DCFs because it's possible. With options, you can bring those possibilities into the DCF. So if you ask me, could Uber become a second car for a lot of people instead of buying a second car? Right now my answer is probably not, but that doesn't mean the possibility doesn't exist. There could be some optionality in an Uber or a Lyft because of what they can do to replace second cars. So whenever you think about possibilities, optionality allows you to bring those possibilities into your value.
The opportunities are options.
If they come with some degree of, what's the exclusivity with Facebook? There are opportunities, but what gives them the optionality? The fact that they were user-based. So that's what you're looking for, is show me what you have that's special that allows you. And the fact that they have the user base is what allows them to create a platform from which you create these options. So opportunity plus something exclusive is what yields the option. So let's take this option and pass it through the test. Is there an underlying option? Yeah, loosely speaking, there's an option. If the value of the cash flows from expansion exceed the cost of expansion, you're going to do it. So there's a contingent cash flow. So there is an option. Is there exclusivity? Depends. It depends on what? It depends on what kind of barriers to entry. And this is the question of what do you have that's going to keep the competition out? The stronger those barriers, the more the optionality. And when you think about applying option pricing to this natural resource option, you're really stretching, right? Because you're taking something you can't trade. In this case, the option to expand and something underlying it that's not traded. So you're really pushing option pricing models to the limit. That doesn't mean you can't attach a number, but it may be very difficult to monetize the number. I forgot to do this. When I talked about natural resource options, I might have skipped this page. Where does the exclusivity come from there? We talked about how having undeveloped reserves, which are non-viable, can be options. Where does the exclusivity come from? If oil prices go to $150 a barrel tomorrow, can you go start digging in your backyard saying oil prices are high, I'm going to find some oil? You could, but my guess is all you're going to do is have a big hole in your backyard. You know what where the optionality comes from? It's natural scarcity. There's only so much oil under the ground. In fact, I'm going to do an extension that's going to sound weird. Do you know that real estate in New York has significant optionality, especially in Manhattan? Every square inch of this island is not just zoned, but there's only so much you can build on it. Square footage has already been determined. I'll give you an example. When we were building the graduate school as a new school in 1992, we got like $60 million from Leonard Stern and discovered how little $60 million actually gets you in New York City. Started building, the architect came out, and he originally had a 14-floor building as the new building. So this was always there, Tisch was always there, but that building was going to be a 14-floor building. We get 6 months into the process, everybody's so happy about the 14 floors. We're talking about finance being on floor 12, and we want the highest floors because you get the best views. And the architect comes back and he says, I made a mistake. We've got to lop off 3 of the floors. What happened? He said there's a certain amount of square footage on this land that New York City allows you to build. So basically that you can and NYU, for whatever reason, had borrowed, don't even ask me how they do this, they borrowed some of this space when they built Kohl's. We have no idea what that even means, borrowed the space. But it means that with that space gone, you couldn't build those extra 3 floors, and you can't just lop off the top 3 because it doesn't work. It took an extra 3 months to come back with new designs. Because now do you see why if you go to the East Village and you see a 3-floor building on 3rd Street, you could multiply square footage by, and come up with a value. But what you'd be missing is if that land you can actually build a 20-floor building. Let's say it's zoned for a 20-store building. Even though today you might never do it, you see why you're going to pay far more than just those 3 stories times square footage? You're paying for the optionality of building those extra 17 floors. It's something, that's why if you look across New York City and you look at building prices, you'll often see some buildings selling at way above what it looks like they should be selling based on the square footage. But what is probably true about that space is that's one of the few spaces where you can build a 90-floor building or an 80-floor building. That's going to add to the value. But don't mistake this for meaning that all real estate has option value. If you go to Kansas City, don't pay a premium on the building saying, just in case. You know what gives Manhattan the optionality? It's the same thing that gives Hong Kong an optionality. Why is there so much optionality? Because you're an island. Kansas City, you want to build, keep building. There's nothing within 15,000 miles of you. I'm exaggerating. But you're in the middle of flatland, right? So you want to grow, you can keep growing. It's because Manhattan and Hong Kong are islands that you're basically kind of constrained. Is Hong Kong an island? Kind of, right? There's only so much land. That scarcity of a natural resource is what adds the optionality. So think exclusivity, and you can see why in some parts of the world real estate will have option values. Which brings me to the last and perhaps most important option to preserve, not just in business but in your personal life. It's the option to abandon. You know what that is? It's the option to be able to walk away from your own mistakes. It's an incredibly powerful weapon to have. So in the context of a project, here's what it is. If you can abandon your project at any point in time, It actually is a good thing, because if your project doesn't work out, if 2 years into a 25-year project say, this is horrible, if the value of the cash flows is less than what you can make from abandoning the project, you're going to abandon the project and walk away with that value. So let's close with a very simple example. You've heard of Lear Aircraft, it makes these small corporate jets. You've heard of Airbus, which makes the big passenger jets. So let's say that I work for Lear and you're at Airbus. And I want to build a small corporate jet at Lear. And I don't have the capacity to do it. I need to enter into a joint venture with you. So I come to you and say, would you be willing to be in a joint venture with us? Let's put some numbers here. Okay? So in this case, let's assume that in this joint venture, you would have to put $500 million, I'll put in $500 million, and we'll produce these small corporate jets. So your Airbus, you work through the numbers, and based on your projected cash flows and value, you come up with an estimated value of being in this joint venture of $480 million. It costs you $500 million to be in the JV, and you're going to make only $480 million. So already you can tell me that your net present value is negative. You're not that excited. But I really, really want you to be part of this joint venture. So I offer you a deal. I said, look, I know this project doesn't look good to you. The present value of the cash flows is less than what you put in. But if you decide to invest in this project and you change your mind any time over the next 5 years, I will buy out your 50% at a $400 million value. Less than what you paid, but what have I offered you now? A floor. You can't lose more than $100 million. I've given you a put option. You see why it's a put option? I will buy your share at $400 million no matter what, and you will exercise that right only if the value, your share of the value, drops below $400 million. Why am I giving it to you for only 5 years if it's a 30-year project? Because if I gave you the right to abandon this project anytime over the next 30 years, you know what you're going to do? You're going to hang in there for 29 years and 364 days, and on the very last day show up and say, you know what, I never liked this project. Can you give me $400 million? So I have to be careful not to give you this right forever. So it's a 5-year project, and the value has some significant uncertainty, 0.16 variance. So I plug the numbers in. The value of the underlying project is, if you take the project today, what's it worth? It's $480 million. The strike price is $400 million. So this is an out of the money option, because remember, it's a put option. The value is to drop below $400 million for you to abandon it. You have 5 years to play this game. The variance is 0.16, and because it's a finite life project, every year the project runs, the remaining cash flows become fewer, so the value actually drops. In this case, I'm assuming it's going to drop by 1/30. The 5-year riskless rate is 6%. If I plug those numbers in, the value that I get for the put option is $73.23 million. You say, what does it even mean? Remember, your original net present value was minus $20 million as Airbus? 480 minus 500. I'm giving you a put option worth $73 million. It doesn't guarantee that you will now become my partner, but you can see how by giving you a floor on your value, an option, you essentially might be much more willing to invest in this project because I've given you the option to abandon. When you start looking at job offers, at getting married, remember, option to abandon is divorce, option to expand is having an affair. Everything is an option, basically. Life is full of options, right? I'm not encouraging you to divorce other people, but I'm saying when you have to enter into long-term commitments, having the option to abandon will make it more likely that you will actually enter into the commitment. Right? Same thing with jobs. I mean, you look at 2 jobs, a job which gives you more flexibility to be able to walk away if things don't work well is worth more than a job where you're kind of locked into a job for the next 20 years. And that's all the option to abandon gives you. It gives you the right to walk away from your own mistakes. So I will see you on Wednesday and we will continue and finish the real options section on Wednesday. Yes. Good.
I just had one question on your project.
Yeah.
What was it exactly you're looking for with the LDA thing that we're talking about operational?
Some measure of operating margins are lower than they should be. You're looking for somebody who's not well managed. So the question is, how do you catch those? You can compare the margins of a company to the industry average. So let's say you find that a company's margins are 3%, the industry average is 7%. You can say, it's a starting point. You can say, how do I know it? Well, you could look for things like that, which are measuring operating success. Because what you want is a trifecta. You want an underpriced company, obviously. You want an underlevered company if you want to borrow, and you want a badly managed company.
I think our project, we got -1. We found underlevered revenue, which you said.
Did you find the badly managed? What did you use as your metric? Finding that? Or did you find underlevered?
This was, well, we mentioned one point. There was a comment above that says that the operational benefit. And under, I had one sentence that basically went like this. Their revenues are increasing, their EBITDA margins are decreasing. This is a sign of bad management because not able to make better production to the company. We got -1. I thought.
I'll give you a half point for that. At least we're thinking about something. But I would say that you want something much more direct because you want to see if you converted the EBITDA's, the trend line to actually a margin. Because the reason that's an incomplete story is if you're going from 17% margin to a 15% margin and you're growing, it might actually be good for you if the growth compensates for the lower margin. But so that's why bringing in the exactly, and going for more scaling.
We were doing company efforts, basically IWC, so I don't think they're possible.
Yeah, so check their overall margins because it might be that they're already efficiently run, in which case the capacity to cut costs and generate operating efficiencies can be limited.
I think, just like from an actuarial perspective, I'm pretty sure they're when they own cardio, IWC, they're a pretty single company. Like, I don't think that they were trying to cut down on their margin. But do you mind if I just send it to you with a note saying, like, I just wanted to have a look at the settings of the revenue?
Okay.
All right, thank you so much.
Take care. You'll find out tomorrow.
Thank you. And also, thank you for emailing me on the article. It really meant a lot, made my day.
Yeah. That was a good article. So I emailed Natasha too. So just let me.
She told me. Thank you.
Just want to take a look at our mystery project.
Yeah.
We did regression for every multiple we chose, which is trailing P and lower P and everything else. But since we want to show you which variables we try, so we get basically the whole picture for you, and then we feel like it takes up too much space to show the final regression for every multiple. So
all I wanted was your final regression. This is the stuff I didn't want to see.
So our point is we had final regression.
We did final regression. We just didn't show you.
We just didn't
No,
screenshot it.
you see what I'm saying? Though you held back the most important part and gave me all the raw material, right? You told me this is all you were showing me the work you did to your final regression rather than the final regression itself.
Okay.
I'm not interested in you putting in a lot of work. I'm just interested in what you finally came up with.
All right.
So why don't you put the final regression in and send it back to me? I'll take a look at it because I don't think it.
Okay, so then
We
should we
did
just
the-
take out the,
You leave it for the moment. The damage has already been done, right? I had to go through like 6 pages of table after table after table, and finally I said, I don't know what.
We only show the final regression for the multiple we actually chose.
Okay.
Yeah. Okay. So we'll send you a new version.
Yeah.
Thank you so
Okay.
much.
Take care.